Imagine waking up one morning and realizing that the smartest money in the world is quietly changing its mind, not with panic, not with noise, but with precision. While headlines argue and markets debate, capital is already moving. Something rare is happening beneath the surface of global finance, something that doesn't scream for attention yet demands it. When institutions that shape markets begin to reposition, it's never random, it's a signal that the rules we thought were permanent are being questioned, and the assets we once overlooked are suddenly back in focus. Today, we're pulling back the curtain on a shift so powerful, so calculated, that it's redefining what safety means in the modern financial world. Stay with me, because what's unfolding right now could change how you see money itself. The conversation around gold today isn't about nostalgia or tradition. It's about risk, confidence, and reality. When capital begins to move in size, it's rarely emotional and never accidental. What we are witnessing right now is a deliberate shift by investors who are reassessing what safety truly means in a world where uncertainty has become structural, not cyclical. Gold has re-entered the conversation not as a relic of the past, but as a modern hedge against a system that feels increasingly stretched. For years, markets operated under the assumption that liquidity would always be abundant, that fiscal discipline was optional, and that monetary intervention could smooth every disruption. That assumption is now being tested. Inflation may fluctuate on paper, but the underlying concern is credibility. When governments spend aggressively, when debt climbs faster than growth, and when monetary tools are pushed to their limits, investors begin asking harder questions. The most important one is simple. What holds its value when confidence erodes? Gold answers that question in a way few assets can. It doesn't rely on policy decisions, earnings projections, or political stability. It doesn't need a central bank's promise to maintain its worth. Its appeal lies in independence, from currencies, from credit cycles, and from short-term narratives. That independence is exactly why investors are reallocating toward it today, not because they expect chaos tomorrow, but because they understand risk compounds quietly. This shift toward gold is not a rejection of markets. It's an acknowledgement of reality. Smart capital doesn't wait for crisis headlines. It positions itself ahead of them. When volatility becomes persistent and geopolitical tensions remain unresolved, diversification stops being a theory and becomes a necessity. Gold plays a unique role in that framework. It absorbs fear without amplifying it. It preserves purchasing power without demanding blind optimism. What's particularly telling is who is buying. This isn't limited to retail investors reacting to headlines. Institutional players, sovereign entities, and long-term allocators are increasing exposure. These are not decisions driven by sentiment. They are driven by models, stress tests, and history. And history is clear on one point. During periods when trust in financial systems is questioned, gold doesn't outperform because it grows. It outperforms because everything else becomes fragile. There's also a psychological layer that markets often underestimate. Confidence is the invisible currency behind every financial system. Once that confidence begins to thin even slightly, capital seeks reassurance. Gold provides that reassurance because it has no counterparty risk. It doesn't depend on someone else's ability to pay, print, or promise restraint. This is why the current gold buying spree matters. It's not speculation, it's preparation. It's a signal that investors are no longer willing to assume stability as a default setting. They are choosing resilience over reach, balance over bravado. And when enough capital makes that choice simultaneously, it tells you something important. The definition of safety is changing, and the market has already begun to adapt. There is a quiet but meaningful transformation underway in global capital markets, and it's not being driven by headlines or ideology. It's being driven by arithmetic. For decades, the world grew comfortable, anchoring portfolios, trade, and reserves around a single dominant currency. That framework worked because it was supported by discipline, credibility, and relative stability. Today, that framework is being stress tested, and investors are responding not with panic, but with calculation. When exposure becomes concentrated, risk becomes invisible until it isn't. The growing movement to diversify away from heavy reliance on one currency is not an act of defiance, it's an act of prudence. Capital does not take sides, it takes notes. And what it's noting right now is persistent fiscal expansion, rising debt trajectories, and policy environments that leave little room for error. In that context, reducing sovereign concentration risk is not radical, it's rational. This shift isn't about abandoning the dollar, it's about balance. No serious investor believes in putting all their faith and all their capital into a single outcome. Diversification is not a critique of strength, it's an acknowledgement that strength must be protected. When deficits become structural and monetary policy is asked to solve problems it wasn't designed for, markets adapt. They always do. Gold emerges in this environment not as a competitor, but as a complement. It exists outside political cycles, outside election calendars, and outside fiscal negotiations. That independence gives it a role few assets can replicate. It doesn't replace productive assets, and it doesn't generate yield, but it provides some. Anything arguably more valuable in uncertain periods, insulation. What's notable is how methodical this rebalancing has been. This is not capital fleeing overnight, it's capital reweighting quarter by quarter, reserve by reserve. Central institutions, long-term allocators, and global investors are quietly adjusting exposure to reduce vulnerability to any single policy regime. That should not be misread as pessimism. It's realism. Markets tend to overreact to short-term signals and underreact to long-term shifts. Deconcentration from sovereign risk is a long-term shift. It reflects a world that is more fragmented, more multipolar, and more complex than the one investors grew up in. In such a world, resilience matters more than elegance. Flexibility matters more than tradition. There is also an important behavioral element at play. Trust is not binary, it fades gradually. When investors begin to hedge currency exposure, they're not declaring failure, they're acknowledging uncertainty. And uncertainty, when persistent, demands preparation. Gold plays a role here because it is nobody's liability. It doesn't depend on coordination, consensus, or confidence in future restraint. This is why the current trend deserves attention. It signals a broader reassessment of how risk is measured and managed in modern portfolios. The era of assuming perpetual stability is giving way to an era of deliberate protection. Capital is not retreating, it's recalibrating. And when that recalibration favors assets that exist outside the system, it tells you something fundamental. Markets are not losing faith in growth, but they are demanding greater insurance against imbalance. In finance, that's not fear speaking, that's discipline. What's driving the current surge in gold isn't a mystery, it's pressure. Pressure created by a convergence of policy decisions, fiscal realities, and market expectations has narrowed the margin for error. Markets are forward-looking by nature, and right now they're discounting a future where stability is harder to maintain, and confidence requires reinforcement. Gold is benefiting not because it's fashionable, but because the environment is doing the marketing for it. Start with fiscal policy. Large-scale government spending has become normalized, even expected. Stimulus programs, emergency funding, and deficit financing were once extraordinary responses to extraordinary circumstances. Over time, they've become structural. That shift matters. When spending outpaces sustainable growth, debt dynamics change. Investors don't need a crisis to see that trajectory. They simply need a balance sheet. And when those balance sheets expand faster than the economy that supports them, markets begin to hedge the consequences. Then there's monetary policy. Interest rates have been pushed up, pulled down, paused, and repositioned, all within a short span of time. The signal that sends to investors is not confusion, but constraint. Central banks are remanaging competing mandates, inflation control, employment stability, financial system integrity, often with tools that are blunt by design. Markets understand this. They price in the reality that policy flexibility is shrinking, not expanding. Gold responds well in environments where policy optionality is limited. Expectations matter just as much as actions. Even the anticipation of rate cuts or renewed accommodation can weaken currency confidence before a single decision is made. Markets move on probability, not certainty. When investors believe that future policy may lean toward easing to manage debt burdens or economic slowdowns, they begin positioning early. Gold becomes a natural beneficiary of that anticipation, serving as a hedge against both inflation resurgence and currency depreciation. There's also the geopolitical layer, which cannot be ignored. Trade tensions, regional conflicts, and shifting alliances inject persistent volatility into global markets. These aren't one-off shocks, they are ongoing variables. Capital doesn't like unresolved risk. When geopolitical uncertainty becomes a constant rather than an exception, investors seek assets that are portable, liquid, and universally recognized. Gold fits that profile better than most. Another important driver is the market structure itself. Equity valuations have been stretched, bond markets have struggled with duration risk, and traditional diversification models have been challenged. When correlations are ice, across asset classes, diversification loses effectiveness. In those moments, assets with low correlation and long-term credibility regain importance. Gold's role strengthens not because other assets fail, but because they become more synchronized in their risk. What ties all of this together is not fear, but adaptation. Markets are adjusting to a world where growth is uneven, policy is constrained, and uncertainty is persistent. Gold is responding to those conditions exactly as history suggests it would. It doesn't surge because investors expect collapse, it rises because they expect complexity. This is what makes the current environment different. The drivers are not singular or temporary, they are layered, interconnected, and durable. And when multiple forces point in the same direction, fiscal expansion, policy limitation, geopolitical risk, and structural market stress, capital listens. Gold isn't leading this conversation, it's reflecting it. The global context surrounding gold today reveals something deeper than price action. It reveals a strategic response by institutions that are designed to think in decades, not quarters. When long-term capital moves, it does so quietly, deliberately, and with a clear understanding of history. What we're seeing now is not a speculative rush, but a structural adjustment by players who measure risk on a generational scale. Central banks sit at the heart of this shift. Their mandate is not to chase returns, but to preserve stability. Over the past few years, reserve management has taken on renewed importance as the global system becomes more fragmented. Trade routes are being reshaped, alliances are evolving, and financial sanctions have demonstrated that access to currency systems can no longer be taken for granted. In that environment, reserve diversification is no longer optional. Its strategic goal occupies a unique position in this framework. It is universally recognized, politically neutral, and free from counterparty risk. Unlike currencies, it cannot be devalued by policy decision. Unlike financial instruments, it does not depend on the solvency or cooperation of another institution. For reserve managers, those attributes are not symbolic, they are operationally critical. Gold doesn't need trust, it commands it. What's particularly notable is the consistency of accumulation. This isn't reactionary buying during moments of stress, it's steady, methodical, and persistent. That pattern tells you everything. Institutions are not hedging against a single event, they are preparing for a world where uncertainty is embedded in the system. When reserve allocations shift gradually but continuously, it signals a redefinition of what stability looks like. This trend also reflects a broader recognition that the global financial system is no longer unipolar. Economic power is distributed across regions with different priorities, governance models, and risk tolerances. In such an environment, reliance on any single reserve asset introduces vulnerability. Diversification becomes not just prudent, but necessary. Gold, by virtue of its independence, becomes a natural anchor. There's also a credibility dimension that markets often underestimate. Confidence in currencies is built over decades, but can erode much faster when fiscal and monetary pressures converge. Central banks are acutely aware of this asymmetry. They understand that once credibility is questioned, restoring it is costly. Gold acts as insurance against that erosion, not because failure is expected, but because prevention is cheaper than repair. Importantly, this accumulation doesn't imply a rejection of modern finance. It reflects an understanding of its limits. Financial systems are powerful, but they are also human-designed and policy-dependent. Gold sits outside that design. It is immune to revisions, debates, and policy reversals. That immunity is precisely why it retains relevance in a technologically advanced, financially sophisticated world. What we are witnessing is not a retreat into the past, but a recalibration for the future. Institutions are building resilience into their balance sheets by acknowledging that volatility, fragmentation, and uncertainty are not temporary disruptions, they are defining features of the current era. And when the most conservative stewards of capital quietly agree on the same solution, markets should pay attention. At the core of every market movement lies a psychological truth that often gets overshadowed by data and models. Capital follows confidence. When confidence is abundant, risk is embraced. When it becomes fragile, protection takes precedence. The current demand for gold is not an emotional reaction to fear-filled headlines. It is a calculated response to a shifting perception of security in global finance. Investors today are navigating an environment where certainty is increasingly scarce. Economic indicators send mixed signals, policy direction changes with political cycles, and long-term assumptions are constantly being revised. In such conditions, traditional safety benchmarks are being reevaluated. The question investors are asking is no longer what grows the fastest, but rather what survives the longest. Gold speaks directly to that mindset. Its value proposition is psychological as much as it is financial. It represents continuity in a system defined by change. While currencies are shaped by policy decisions and assets by performance expectations, gold exists independently of belief. It has endured because it doesn't require persuasion. That quality becomes increasingly attractive when trust in systems rather than assets is what's being evaluated. What's notable is how this shift manifests across different classes of investors. Long-term allocators are using gold to stabilize portfolios against systemic risk. Institutions are positioning it as a hedge against currency dilution. Even sophisticated investors who thrive on volatility recognize that there are moments when exposure must be tempered by preservation. This is not defensive investing. It's disciplined investing. Markets often underestimate the power of perception. When enough participants begin to question the durability of financial frameworks, behavior changes, liquidity becomes selective, risk premiums widen, and assets that symbolize permanence regain relevance. Gold benefits in these moments not because it promises upside, but because it limits downside. That asymmetry matters. There is also a signaling effect that should not be ignored. When respected institutions and seasoned investors allocate toward gold, it influences expectations across the market. Confidence doesn't vanish overnight, but it does migrate. And as it migrates, capital follows. This creates a self-reinforcing dynamic where gold's role as a stabilizer becomes more pronounced. Importantly, this does not suggest an imminent collapse or loss of faith in progress. It reflects maturity in market thinking. Experienced investors understand that cycles are inevitable, that policy errors occur, and that resilience must be built before stress emerges. Gold is part of that preparation, not as a bet against the future, but as insurance within it. Ultimately, markets are expressions of collective judgment. The current gold buying trend reflects a collective reassessment of risk, credibility, and durability. It tells us that investors are not abandoning growth or innovation. They are simply anchoring it to something that has proven over centuries to hold value when narratives fail. In a world where confidence is constantly tested, the assets that endure are the ones that don't need reassurance. As the noise fades and the charts close for the day, remember this: the biggest moves in history never begin with chaos. They start with quiet conviction. While the world debates tomorrow, capital is already preparing for it. The question isn't whether the financial landscape is changing. It's whether you're watching closely enough to recognize the shift while it's still unfolding. Because when confidence moves, markets follow. And by the time the signal becomes obvious, the opportunity has already passed. Stay alert, stay curious. The next chapter of global finance is being written right now, and it won't wait for permission.